I'm going to ask you to indulge me at the beginning for 2 or 3 minutes, because I'm going to do a little bit of sort of history and theory just to sort of set financial stability into context, because I think that's very important and actually not often done enough, I think. So one of the really sort of founding fathers of financial stability was Hyman Minsky, and the point Minsky made, and it's a really crucial one, is that money and finance matter together for understanding economies and their susceptibility to stress. And this is the point that Klaus has been making about particularly about the non-bank world. And Minsky's point was that unstable finance contributes to economic instability, and the institutional arrangements by which money and finance operate are therefore crucial. And it underlines the point Klaus made that if governments don't support that, they will regret it and spend a lot of time focused on it whereas they want to be focused elsewhere. Now, capital and financial instruments are traded and their prices are rightly determined in markets. That's linked to but separate from prices in the general economy. And of course, as financial practices change, and this is, again, as Klaus said, coming out of Pittsburgh, economies can oscillate between robust and fragile states. And of course, it's the latter that contributes to financial crises. And then, and I'm going to again reiterate a point Klaus has made, as the memory of previous crisis recedes, it's not unusual to believe that you're in a new era, and that Cassandra-like warnings from people like Klaus and me are sort of, behind the times. Now, that was the theory. There's quite a lot of history on this as well, and I wanted to draw out just a few points of history, because again, the history really makes the point that connections between financial markets and macroeconomies extend beyond money flows in the banking system. It's not a new point, actually, not at all. And the sort of shocks that go on in that world can change investment opportunities. They can prompt high spirits, overshooting of equilibrium price levels in asset markets. But over time, those expectations that asset prices are going to continuously rise weaken, and that's when the distress sets in. And Adam Smith had quite a famous observation on this when he said that when the profits of trade happen to be greater than ordinary, overtrading becomes a general error. And he said most rapidly in countries that are going fastest to ruin. Smith didn't sort of mince his words in that sense. And if you look at more recent history, the Great Depression, much associated with bank failures, but actually driven by critical interactions with financial markets that reduced the wealth and collateral available for borrowing, led to reduced credit supply and forced liquidations and business failures. And then you get debt deflation, and then you get the credit channel of transmission. And that is what we spend so much time in the world of financial stability counteracting. Because, as Klaus said, if you get into that world, you then need extraordinary public policy measures, and measures which are absolutely necessary in the short run, but are not compatible with long-run stability. You have to do what you have to do. And as Klaus rightly said, there comes a point when you then have to undo what you've done. So, I'm going to stop the fear in history there, and I'm going to start, in a sense, applying that to today with a general point. There is a tension in the world of financial stability, I think, because what I would call the more systematic macro-prudential approach, and an approach that becomes more like a sort of disaggregated laundry list of potential risks. Macroprudential policy must focus on the system-wide risks, taking into account correlations, concentrations, opacity, interconnectedness. It's actually a more ambitious and harder to pull off approach. It tends to wane as a tool in its popularity as a tool, and as Klaus was making this point, as memories of the most recent crisis fade. And you tend to see a reversion to the more list-like approach. And I think we have to lean against that. We do have to keep this focus on system-wide risks and ground what we're doing. So, my first message today is that I think taking the macroprudential approach matters. It's harder, but it matters. Second message, come back to Cassandra. So Cassandra was fated by the god Apollo to utter true but unbelieved prophecies. In FS speak, she was dedicated to one tail of the distribution. She may have missed her vocation as a central banker. maybe the disbelief was because, as Minsky would have said, memories of financial crises, memory of any crisis fades fast. And as Klaus said, I'm afraid this is evident now in the memories of the global financial crisis 15 years ago. Memories are fading. People sometimes say to me, well, you've solved that, we can relax. But the work of theory and history is timeless, and it warns us, actually, you can't fall into complacency. We must always debate levels of regulation. That's the right thing to do. The debate about growth and competition is the right debate to have, but we can't ignore the timeless nature of financial stability. That's the second message. The third message really focuses on the critique Minsky made of what was actually post-war Keynesian economics, though not actually Keynes himself, and the point that money and finance matter together because of their interaction and its potential to cause instability. Now, before the global financial crisis, there was a debate that centered around a question that was much too limited, which was, were we in a world of asset price bubbles or not? That sort of ignored all the interconnections. Now, as Klaus said, since the crisis, the global scale of bank and non-bank finance has shifted towards the latter. And so again, as Klaus said, rightly, we've had to shift our focus. Now, we've increased bank regulation. That was an absolutely necessary thing to do coming out of Pittsburgh to reflect the crisis. But macroprudential risks in the non-bank sector have not originated just because of the shifts we've seen in the last 15 years towards it. They were there in the 19th century, actually. So this is a lesson that we've seen before. But the shift, and this is the third message I give, that relative shift towards non-banks since the financial crisis makes these risks more pressing, even though they're not new. Now, the non-bank world and its interaction with banking, money and finance, has evolved in ways that require us to look beyond regulation to surveillance and the tools of remedy. So my fourth point is about surveillance. The non-bank sector is large, it's disparate, it's opaque, it has complex and hard to observe interlinkages, it has hidden leverage, as Klaus was saying. In the banking sector, one of the big tools we developed after the crisis was stress testing of banks. Those stress tests are institution specific, though they actually, in doing so, we seek to capture system-wide risks. But in the non-bank sector, we have to focus, in the spirit of Minsky, on how risk spreads, to identify the points of weakness in markets, in infrastructures, and in firms. And issues like leverage are the way in which those weaknesses become apparent, but it's the spread, it's, if you like, it's the flow of risk that we have to be more focused on in the non-bank world. So at the Bank of England, we're conducting our first, what we call system-wide exploratory scenario, which is designed to do this. It's designed to simulate shocks and observe their effects as they flow through the system. It's not institution-specific in that sense, it's a flow test. We're going to report the results by the end of the year. So my fourth message is, I think we are reaching a pivot point where, and I thoroughly endorse Klaus's point that we've got to implement the remaining rules and regulations, but we also need to develop better surveillance tools for this world, where flows matter and points of blockage matter. Now, you'll be pleased, I hope, to know that my fifth point is the last one. And that's about the tools that we as authorities use in a crisis. I made the point earlier that surviving extraordinary crises can require extraordinary measures. And sometimes we have to solve short-run situations with measures that are not consistent with long-run stability if they continue to be used. But they are necessary nonetheless. You have to do what you have to do, as Klaus said. Central banks provide last resort liquidity to the banking system. That goes back, of course, a long way in history. Now, that liquidity is rightly focused on the banking system. Its money is unique. Money must hold its nominal value. What I call the singleness of money, whether it's provided by the central banks or it's in the commercial bank system, holding those two things together with constant nominal and real value is absolutely crucial to the centrality of the money system. And so if a central bank injects money into the banking system, it's to do that. Now, historically, it's also because we believe that if we inject money into the banking system, it will, I think to paraphrase the Heineken advert, reach all the parts that are needed to be reached. Now, I think the proposition that there is a unique and powerful relationship between central banks and banks holds true throughout. The third point I made, I think it was the third point I made, will injecting money into the banking system always reach all points where it's needed? I think is much more open to question. Now, I'm not going to talk a lot about LDI, contrary to Klaus's invitation, but that was one of the key challenges we had in that case. It wouldn't have worked. So I think the growth of the non-bank sector has given us as central banks the challenge. How do we meet that challenge? How do we meet that challenge in extraordinary circumstances of getting liquidity into the non-bank sector? But we do not compromise the fact that the relationship between central banks and banks is unique in terms of the value of money. What that means is banks are always able to come to the central bank for liquidity. Non-banks don't have a right to come to the central bank for liquidity, but there are times when we have to provide it. And I think we've learned that we have to provide it on a more systematic basis as an emergency tool. In other words, we have to say, this is what we will do if there is an emergency. And in saying that, we then have to be prepared, in a sense, to be good to our word, when we judge there to be a crisis. And so that's, again, to finish, what we're doing at the Bank of England. We're designing tools and putting them on a more, if you like, consistent basis to say these are the tools we will use for non-banks in a crisis, but they are not standing tools of liquidity provision in the way that we do it with the banking system. So to sum up, we have a very big agenda. We have made a lot of progress, but I agree with Klaus, there's a lot to do, and we cannot let the fading memory of the crisis take away the importance and crucial nature of financial stability. So just to summarize very briefly my messages, system-wide matters must not be overlooked. We must heed the warning that memories of past crises fade. The shift towards non-banks presents renewed challenges. I think we need better surveillance tools. And central banks must reconsider their liquidity provision tools for non-banks without undermining the singleness and uniqueness of money. Thank you.